Welcome to Value Investor TV podcast. My name is Becco, and this is Hari. This is a podcast that helps you grow your wealth and become financially independent. Welcome, people. Okay, this is episode 18, Cashflow Statement Part 1. We're going to talk about Cashflow Statement. This is the third financial statements in the mix. As we always do, let's do a quick reminder of what we talked about in the previous two episodes, 2 or 3. Okay, in the past 2 episodes, we talked about balance sheet. We talked about asset, liability, and equity. And in the episodes before that, we talked about income statement, which you can check out in YouTube or any other podcast app that you listen to. Okay, in this episode, we're going to talk about cash flow statement. This is a financial statement that's sometimes ignored, and people overlook the importance of cash flow statement. But for value investors, this is very, very important. Okay, let's dive into cash flow statement. And before we do that, why don't you, Hari, please define cash flow statement for our listeners before we jump into what is in it.
Yeah, so when we talked about the income statement, we actually talked about accrual-based accounting, right? And accrual-based accounting is different from cash-based accounting. So the difference really comes down to, in accrual accounting, you're using, when the revenue is booked is not necessarily when you get paid. And so in the cash flow statement actually comes several years after the income statement and balance sheet were mandated by the SEC. And so, they added this in to kind of just illustrate, how is the cash actually coming into the business, right? And so, the cash that comes into the business is coming into 3 different areas, and those, those come from the operating activities of the business, the investing activities of a business, and the financing activities of the business. So, we'll talk about those 3. The main purpose of that cash flow statement, though, and using this cash-based accounting, is to tell you that, some businesses actually have an accounting profit, but they have negative cash flows. So they are spending more money. Cash is moving out of the business faster than they're actually, able to put it back in. And there could be a lot of different reasons for that. And then there are other companies that actually run a accounting profit and are losing money,
Cash flow positive.
Yeah, I'm sorry, cash flow positive, and are running an accounting loss every year. Yeah. And that can be also, for a lot of different reasons. And, you want to kind of understand, because at the end of the day, really, as, we have always said, you're thinking like an owner of a business. The owner of a business cares about one thing, which is making money, right, which is profit. But it's not accounting profit that they care about, right? They care about cash profit, right? It's money you put in, that you can take out of the business and put it into your own pocket, or go and invest it into growing your business. That's really what matters. And that the cash flow statement actually tells you that, and we'll show you that adjustment in a later episode, but the pieces of the statement are actually in here. And that this is how, I know we're 18 episodes in. We keep talking about value investing, and we haven't actually shown you how to value a business. Well, this statement is actually where the value of the business comes from, or is one way to calculate that value. And using these methods, you can actually identify how much cash the business generates, on average every year, and then use that to make an estimate of what the business is worth.
Right. Yeah, so the important distinction of cash flow statement and reason why it exists is because income statement and balance sheet follows the accrual-based accounting, whereas this is cash-based accounting, cash flow. So you can see actual cash, hard cash moving in and out of the business if you peruse cash flow statements.
Yeah, and a good way to think about this is the cash flow statement is very similar to your bank account statement. The bank statement that you get every year, every month, or so it's for a period of time, and it shows you what went in, what went out of the business. Mm-hmm. So, it's not, and in that period of time, where did the cash move? That's really what you should be thinking about, when you look at this statement. Mm.
For me, a cash flow statement is more simple to understand if you really if you
Yep.
get a better sense of it, because you don't have to deal with all the accounting rules. It's just
Right.
simple hard cash coming in and out of the business.
Yeah.
Okay, let's dive into the anatomy of cash flow statements. I know you mentioned, Hari, the large three breakdowns in the inside cash flow statement. You said operating activities is one bucket, investing activities second bucket, the third bucket is financing activities. Those are three activities by which cash moves in and out of the business. And why don't you take us through the first bucket first, which is operating activity and how that is structured?
Yeah, so at the top of the cash flow statement, remember all these financial statements are linked in some way. So the cash flow statement is linked to the income statement because the net income that you have at the end, which we call the bottom line in the income statement, is pulled over into the cash flow statement and is the top line of the cash flow from the cash flow from operating activities. So what you start with is that net income, and then you take what you're essentially doing is you're taking out all of the expenses that weren't actual cash expenses and adjusting those expenses to get to your cash from operating activities. So when you start at the top, you start with net income. So remember, in the income is that accounting profit. And we're going to adjust it for when did the cash actually move in and out of the business. And then at the bottom of that, we will have what's called the net cash flow from operations. And we that number is very important because that's the actual cash increase or decrease from operating activities that year.
Yeah. I just want to jump in here really quick and talk about cash flow statement and balance sheet and income statement really quick, because this made, when someone told me this made complete sense. So a balance sheet, again, like we talked about in previous two episodes, is a snapshot. It's a bank statement, right? Cash flow and income statement, they are both how the company did over time. It's not a snapshot. It's how the company did over time, over some period, be it quarter or be it a year.
Yep.
It's just different way of accounting money effectively. Cash flow is cash-based. Income statement is accrual-based.
Yep.
So again, here, like Hari said, this is cash flow, cash coming in and out of the business within a certain period of time. I just wanted to reiterate that to our listeners.
Yeah. So, I think once when you really understand that concept that cash flow is income, is not the same thing as income, because of the way the accounting rules work. That doesn't mean that the income statement isn't useful, right? Because it does tell you something very important.
Mm-hmm.
But cash flow, you have to use these together. And I think, as you said earlier, people often ignore the cash flow statement because they just look at, if you look at headlines on any financial newspaper, they always report revenue and they report earnings per share. And they don't really talk about cash flow.
Yeah.
And and that can be very important to how businesses operate. Obviously, if you don't have enough cash, you run out of business. So when you start that top line, what you're essentially doing is you're taking out all of the, adding back in all of the non-cash expenses that we took out in the income statement,
Yep.
right? So that first thing that you do is you add back depreciation and amortization,
Mm-hmm.
right? And, we will, there's a lot of chicanery that goes around with these depreciation and amortization because, people report these numbers, but depreciation and amortization, we should always think of as real expenses. Even though they're not cash expenses, they're still expenses.
Mm-hmm.
So then now you're back down into the, after you've added back depreciation and amortization, you're going to adjust for the net payments to your suppliers and to your customers. So what that effectively does is reconciling, that revenue number with the accounts payable number that you see in the balance sheet.
Yeah.
And so that so if you imagine that you collect cash from your customer, so you ship them a good, we ship them hot dogs in our catering business, and we tell them that we have 30 days to pay. So in 25 days they get the invoice and submit it back. So those 25-day period may fall into two different quarters, depending on when we do that. So the income may have been in that first quarter and the cash flow is in that second one. But when we collect money from our customer, that's when it's recorded here now in the cash flow statement, even though we booked the revenue in a previous quarter.
Right.
There are other things that you get, from your operating activities that, it's important to understand that the ones that you're looking at there, collections from your customers are a big one, but then you're also having to pay your employees, pay your suppliers. So, things that are related to the business activity, it's very important to distinguish that from the investing activities and financing. So, investing and financing are, something we'll talk about in the next episode. So this is really just how does the cash move in out for the day-to-day business, the operating, business of the company.
Yeah.
And so, every time you're making payments, that's money is going out as cash. And so some of that is already being deducted in your income statement, right? And so, but we're just reconciling those payments with the cash outlays.
Yeah.
So that helps us understand, if you have a long time to pay your suppliers, you may be seeing, and Costco does this, they get favorable terms in terms of payments. And so they are able to receive goods and then pay for them 90 days or 120 days later, whereas another retailer that's much smaller may only take 30 days to get, to payment. So there may be big discrepancies in that cash flow to income statement. So really what you're doing here is not subtracting all of the expenses. You're only subtracting the expenses to, get you back to the net of, that the cash is moving in and out of the business.
Right. I think that's really important to emphasize, in my opinion. So all we were doing in cash flow, at least in the operating activities section, like I said, there are 3 different sections. The first one we're looking at today is operating activities. That section, all it's doing is you're taking the bottom line from income statement, which is net income, or earnings, and then pulling that income to the top line of cash flow, and everything below within operating activities is just reconciliation between accrual-based accounting and cash-based accounting.
Yep.
That's all that's happening. And the Kari said there are different examples of companies that might have a huge discrepancy between cash flow and income statement. And then some companies that might not, right?
Yep.
It might be just very simple. When you get cash in, you also get income, and there's no difference.
Yeah.
Some companies might have that
And,
construct.
I mean, there are some businesses that are. I mean, our hot dog stand could be a cash only business, and in a cash only business, for the most part, the income, with the exception of depreciation and amortization, everything is just cash. And so, we may have to go. We may walk into the grocery store and buy our hot dogs, and we pay cash for that then, and then we pay cash for where we receive cash from our customer. But obviously in the real world that it doesn't necessarily work that way, and the larger the scale, the bigger opportunity you have to make concessions with your supplier. So companies like Costco, because of their size, are able to just say, look, we'll offer you some benefit, but give us a better payment time.
Mm-hmm.
And so because they have time to float that. Now if Costco were in financial trouble, like we talked about with Sears, and
mm-hmm.
Sears is now declaring bankruptcy,
Mm-hmm.
May not get those same terms. So this is really important to pay attention to, because if those payment terms change, then trying to compare 2 years ago, 3 years ago, when they had operating under different premise with their suppliers,
Mm-hmm.
it no longer applies. So cash flow may be more difficult to estimate or to understand. And one of the things that we as value investors have to really pay attention to is there are things that are just in this too hard bucket, right? Which are, I understand the business, but I don't understand their, because payment terms have changed, suppliers have changed. Maybe I should wait 3, 4, 5 years before I can really pay attention to this company. And, that's we haven't really talked a lot about this, but when you're going down this income statement or balance sheet or cash flow statement, if you run into something where you're just like, this may be over my head, and you will, especially if you're a beginner. It is okay to say, I don't understand, and move to something simpler, right? And, there are a lot of businesses out there that are very complex, and they're using these weird financing terms and things like that. So understanding the cash flow statement, which should really be, as Becca was saying, the most straightforward statement in the financials. If you are not comfortable with what you're seeing, or you're not able to understand it, it may not be that the company is committing fraud or anything like that, although that is still a possibility. It's more likely that, some businesses are more complex, and you should step away from those until you're really comfortable with them.
Mm-hmm. Yeah, absolutely. Okay, so that was the operating activities. Again, we can provide a link to a table that we have in front of us. This is a nice summary of cash coming in and out of the cash flow statement. It nicely captures everything that we've talked about here today. Excuse me. So that is the operating activity. What we talked about today in this episode, that is the operating activity section of cash flow statement. And there are two left. Cash flow from investing activity. And the third one is cash flow from financing activities. And we'll talk about those in later episodes. But today was all about operating activities. And just to recap, this is all about reconciliation between accrual and cash-based accounting. You take the net income from income statement and then do the adjustment, and you get the net cash flow from operations at the end of that. Okay, anything you want to add to this?
No, I think we've got it. We got it all covered, and we'll kind of bring it together in the next talk with when we talk about investing and financing activities also.
Okay, that sounds good. Thank you guys for listening. I'll see you on the next one.